There are 1,000 stocks out there that could make you rich, totally independent of what you do for a living.
There was a time when I knew almost every single ticker for all of the major companies that are public. Walmart, WMT, AT&T, T, Best Buy, BBY. I wouldn't be able to do that now. It's too busy now to keep up with which companies are public and which ones are not.
That's because more companies are choosing to go public now due to a booming stock market.
We were in the midst of the longest bull market on record. Then the pandemic happened. And we're right back at it. The stock market is soaring. Companies feel like now is the right time to go public.
So, welcome to Axios' next short course on the latest trends for going public. Going public is a spotlight moment for companies. And beyond the glamour, there are good reasons to get a ticker symbol.
The primary reason a company might decide to go public is because they need cash. Going public means that you're unleashed in this giant world of new investors, new ways to raise cash, new ways to fund your business.
Think about it. Once the public can buy shares of a company, the company can use that money to reinvest in its business. Initial investors can recoup their investment, and other investors can get in on new shares. So, what's the catch?
Once they're public, well, you get to see how is their business doing? How are sales? It's an interesting level of visibility that private companies do not ever have to adhere to.
And that changes how a business operates, making it a big decision that isn't necessarily right for all companies. Traditionally, companies go public with an IPO. Here's how it works. A company partners with an investment bank to underwrite the process.
An investment bank is going to be the company's kind of tag team partner to help them market their company, build a book of investors who were interested in buying shares of the company, and ultimately decide what those shares should be valued at.
Then, they take a bunch of financial paperwork to the SEC. If these check out, they'll set a date for the IPO, and the company starts drumming up support among investors at roadshows.
The same way that, if you're at a job fair, you go around every table and you sell yourself to a company. Well, companies are doing that, but to investors, and they're trying to convince investors to invest in their company and trying to gauge demand for their shares.
At the same time, stock exchanges like NASDAQ and the New York Stock Exchange are competing to list the newest, hottest companies.
Once a company lists its shares, it's kind of off to the races. They are a public company.
IPOs aren't the only way to go public. There are direct listings, which are like IPOs, but without the underwriter or the fanfare. There are direct listings with the option to raise money. And of course, there are SPACs. More on those later. Point is, there is a widening number of ways for companies to go public, and that's because of the stock market.
We're seeing these mechanisms pop up because exchanges want to give companies as many options as possible to go public.
The companies listed on our stock exchanges matter. They're in our index funds, 401ks, and pensions, and they drive wealth creation.
This is a major cornerstone of our financial markets, and these are companies that we interact with every single day, and this is the primary way that they fund their businesses and raise money, innovate, and offer new experiences. And it gives average Americans the chance to buy a piece of that.
Here's what you should remember. The stock market's boom is encouraging more companies to go public. An IPO is the most traditional way to get listed on a stock exchange. But there are more new ways for companies to go public today. And one of the trendiest ways to go public this year has been via SPACs. Learn how they work in the next lesson.